back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, coming at you today from my New York studio. No LaGuardia Airport for me, thankfully. And joined as always.
Your Denver studio. Your Denver studio. You said your New York studio.
I said New York. I meant Denver. Todd Anderson is in our New York studio. How are you doing, Todd?
Yes, I'm well. Peter, how are you?
I am well. And Joan, are you in your home office outside of DC?
I am. I'm in the DC studio, I guess.
Okay. Okay, great. So just Jonah, quick 30 seconds on the Claris Group before we get into it.
Sure. Claris Group is an advisory firm focused on the future of financial services. We work with fintechs and banks and payments companies who are trying to do something new and interesting. So thanks for having me back.
My pleasure. Great to have you
Always
back.
great to have you.
So yes, busy news week as always here. We're going to start off with Silvergate. Today was not a good day for Silvergate, particularly if you're a shareholder. So Silvergate basically said late yesterday that they're going to miss their March 16th filing deadline, which is already an extension. And now they've basically said a statement saying they're going to have more losses. It's not looking good. They may have difficulty in continuing as a going concern. You don't like to hear that from your bank. And their stock was down predictably a lot today, 58% or thereabouts. And, they've had all kinds of crypto firms come out distancing themselves from their bank, from the bank they used to work with. So it's been an interesting day for Silvergate. Joan, I'll start with you because you've been following the crypto space for a while. What do you make of Silvergate's challenges here?
Yeah, I mean, it's it's hard to see how they get through this at the end of the day. They had built a business almost entirely around their network, and the network was really powerful because if you were a big player in crypto, you really wanted to bank with Silvergate and be a part of their Silvergate exchange network, which facilitated 24/7 dollar payments. That was powerful as long as everybody else was in it. And I think now that folks are making other arrangements and leaving the bank, that starts to fall apart quickly. And there wasn't much else for Silvergate to fall back on. That was really the core of the business. And I think, what's interesting here is it's not like they had taken a bunch of crypto deposits and gone out and made, 30-year mortgages with them.
Right.
They were holding treasuries. And I think what they just failed to anticipate was that they had correlated risk that, the crypto markets might go south, at the very same time that interest rates were going up, and that, those two things might be correlated. And if they happened at the same time, it would be really, really bad news because all those treasuries that they held and would have to sell for liquidity purposes would be worth less than when they bought them. So I think that's it was in some sense a perfect storm, although, with the benefit of 2020 hindsight, I'm sure we can say that they should have seen some of it coming, but it's hard to see where they go from here.
Right.
There was I'd be curious your thoughts on this, Jonah. There was a story, I think, a couple of weeks ago that mentioned, part of the failure of some of the Silvergates of the world was, or can be tied back to obviously Silvergate made their own decisions, but can be tied back to regulators in that they haven't, been as forward thinking on crypto, and a couple of the smaller banks took outsized risks that if regulators were more accepting of crypto, maybe the risk would have been spread to a lot more banks and the impact on individual banks might have been less. And maybe some of the FTXs of the world don't happen because they would have adjusted their risk policies to what banks' risk policies would have been. And that maybe some of what we're seeing today maybe not have been as dramatic. What are your thoughts on kind of that perspective? And obviously Silvergate's made their bed. They didn't have to do any of this, but it does, there is some truth in that thinking. And I was just curious what your thoughts were on it.
Yeah, well, I think obviously if you had, sort of crypto deposits and payments activity spread more broadly throughout the banking system, it would have been less concentrated in any one institution. I think the challenge is what I was getting at before, which is the magic of the Silvergate offering was that it offered the potential for 24/7 payments in dollars, which is not something you can achieve across banks in the United States broadly these days, right? So I'm not sure how you replicate that. Signature had their own version of it and didn't run into the same problems, partly because Signature itself is much bigger. So the crypto business is much smaller as a percentage of their overall activity. So, I'm sure that's a little bit of what bank regulators are thinking about now. And you've seen them issue statements saying, we're really wary about businesses that are heavily concentrated in crypto. And I think that's pretty clearly pointed at the Silvergates of the world for whom this was, most of the business. So I think there was a reason that activity concentrated in really just a couple banks. It was really a workaround the lack of a broadly available 24/7 real-time payments function in the U.S., but clearly left concentrated risk.
Right. Okay, we need to move on though. We're going to talk more about crypto later in the show, but now I want to talk about Klarna because they released their financials this week, and obviously the massive buy now pay later company out of Sweden that has lost a lot of money, shall we say, in 2022. They they obviously provide financials in their local Swedish currency.
Them and Stripe are just trying to figure out who can lose more money in 1 year.
Right. So anyway, net loss of just around $1 billion equivalent, 47% increase from 21. At the same time, this is the FT put this in their headline. The CEO, Sebastian Siemiatkowski, I know I haven't messed up that name, but he's got a pay increase, a 35% pay increase despite all these losses. He's saying the company's going to start making profits again by Q3. They used to be profitable before they went on this growth spurt, and they really tried to attack the US market, and they've been successful in the US market. They're everywhere, and they built a pretty sizable business here, but can't seem, it's a huge. I mean, I'll be surprised if they can make profits by Q3 with that massive of a loss in 22.
I'd be curious what happens to the CEO if they aren't profitable in Q3, because isn't the 35% pay raise a bet that they will be profitable by Q3? So. And if he doesn't make that number, what is that 35% increase for? Because obviously they were profitable for many years, and they said, all right, we're going to invest in the business and we're going to invest in new markets. Obviously they probably went way above their skis like everyone else did with hiring and everything in 2020 and then 2021. Yeah, I mean, that'd be quite the turnaround from losing $1 billion to making money.
Jonah, thoughts?
Yeah, it's a lot of money. I mean, we don't, they're a private company, so we don't have a lot of granular insight into what's driving those losses. And I suspect it's more than just their investments in growth in the US at this point. If you look across the BNPL sector, the Klarna model is largely that, zero interest pay in for model. And that's really hard to make work in a zero interest in a world with, interest rates that are now not zero, with a credit market, credit sector that's deteriorating a bit. So I suspect they're seeing losses on the credit side. I suspect their funding is challenged, and they're going through a little bit of what the other BNPL companies are going through. But obviously that's a guess because I haven't seen their actual financials.
Right. Yes, indeed. Well, one day they'll be a public company, I'm sure. But and we'll get a bit more insight. But anyway, let's move on to a public company that is going through its own challenges. Goldman Sachs. They had their investor day this week, their second investor day, and the CEO David Solomon was under fire a little bit. There was no kind of big announcement that got investors excited. In fact, the stock ended down after their investor day, and they did say this big foray into consumer finance that we have been following since day one here at Fintech Nexus back in 2016. In fact, before day one, and looks like that's over, and they're looking now to divest potentially. Talking about selling Green Sky, which they bought I'm not sure when, it was like a couple of years ago, I think now, and talking about maybe getting rid of other parts of their consumer finance business. Investment banking is what they've made their name on, and that's still their core business. And this other parts don't seem to be as important as they used to be. Todd, what do you think?
I mean, I wonder if everything plays out the exact same, but David Solomon doesn't say some of the stuff he said when he first came in about being or becoming a consumer finance business, and just focused on their core business, but still had the consumer finance division and everything. If the investor sentiment is the same as it is today, because overall it was not a large part of their business. I think
it was
part of
losing
it
money.
was,
It was losing money.
I mean, it's obviously it lost money, and part of it was he came on and wanted to remake Goldman Sachs, and it's going to be a consumer finance business, and they're going to be all this forward thinking stuff that they're going to do, and so he's kind of eating his own words in his vision, and I think part of it is his own fault for saying all that. Because if you look at everything in what Goldman does, it wasn't the large part of their business by a long shot, but he said it was going to be a core to their future. So,
yeah, I think you're onto something with the expectations there, Todd, and I think probably gets more attention in some ways than it deserves. I guess the question was always, how do you fit this into the broader strategy? Where's the synergy between this business and the core Goldman Sachs business and franchise? And I think they've made a handful of bets, broadly speaking, under the consumer umbrella, and it looks like they're shedding some of them. The interesting one is Green Sky, which does seem to sort of make sense for a bank like Goldman to own. It's essentially just an origination platform of, that they can leverage in different ways, but maybe that's the valuable piece that they can sell, so they got to sell it. I don't know. So it'd be interesting to see. I think, I hope people don't take the lesson from this that it's impossible to innovate within larger institutions, but that's clearly something people will take away from this. I just think this was also asking an awful lot. You were asking an institution that didn't have a consumer bone in its body to build a consumer business and do so in a challenging, competitive fintech environment. So again, I think there were some unique challenges here, and I hope people don't, broadly sort of take away the lesson that, we should not try anything new ever.
Right. No, that's hopeful.
And I wonder if some of Goldman's own reputation played into this, in that, people see them as a high net worth, smart guys on the block type firm, and to come down into consumer and then go away from maybe the super high prime type borrower and the high net worth or the high earner of that category, to go into the everyday consumer, was probably too much of a leap to begin with. Chase obviously serves 60 million customers, and so do some of the other banks, in terms of, and they serve customers of all stripes. Goldman was serving a specific customer, and going down into consumer was probably like, I'm not going to go to Goldman if I have all these other options. They're not for me.
And they wouldn't have even done this, I don't think, but for the financial crisis, and they sort of became a bank. They were a retail bank, and they had a retail banking license. They thought, what are we going to do with it? Let's do something. Anyway, let's move on. I want to talk about Marqeta because they had earnings this week, and they're a fintech that's doing reasonably well. Of course, they're not making money. Fintechs don't make money, but they are, I'm jest, because fintechs are going to make money at some point. But they exceeded analyst expectations on the revenue side. They had lower losses than expected, and this was the first one from their new CEO. How do you say his name, Todd? Simon? Is it Califf?
I believe so.
Yeah, and so we've got him as a speaker in our keynote speaker at our event coming up here in May, which we're excited about.
You're giving away inside information.
I know, but that's if you watch the news show, you get inside information. Let's just say that.
Well, that announcement
we haven't formally
soon.
announced him yet, so that's going to happen. So anyway, good, solid earnings report, and I think Marqeta's seems to be doing pretty well.
I mean, this is the type of fintech that can weather the storm probably better than others. And embedded finance is only increasing in its usage, and the amount of everyday brands that are relying on embedded providers is only increasing exponentially across all sectors of the economy. So I mean, I think they're set up well, and I think it's the area of fintech I think that has the most promise, at least as we sit here today.
Yeah, I think Todd's right. They're very well positioned. Embedded finance, banking as a service is fairly crowded these days, and it's not clear that everybody who's making a run at it will, ultimately come out the other side. But there is a decent amount of room. It's a growing market, in particular as you look beyond supporting fintechs to, supporting SaaS companies and bigger tech companies in the sort of true embedded finance mode. And I think you've seen the other BaaS players start to add card issuance to their offering, and so now Marqeta, which grew up as a card issuer, is adding embedded finance and banking services. It just makes sense. So we'll start to see these players compete more with each other, and but there's a lot of opportunity out there, I think, and it's to your point, Todd. There's just more and more interest in it. I mean, we're talking to people all the time who are vertical SaaS providers who are figuring out how can we embed and layer in, the payments and account functionality that inherently is tied into activity on our platform, but that we don't provide directly today. And, there's only really one way to do that now, and that's to plug in through somebody like a Marqeta or one of the other banking as a service providers. So we think it's a super exciting, interesting, growing space.
Yeah, and that's sort of every company becomes a fintech type thing. If you've got a platform that you can monetize the payments from, Marqeta's got. There's a lot of runway. That's my point in what they're doing. Yeah. Anyway, I want to move on to Better.com. They've been in the news. They were in the news a lot last year when they had their challenges, but now they're in the news for an innovation, which I think is actually pretty cool. They launched the Equity Unlocker. And they've got a beta client in Amazon. The way it works is you work for some of these tech companies and you have a lot of equity. In fact, this article described the fact that there's a good chunk of millennials that actually have equity in the companies that they work at. And this is what they basically say. You can pledge your invested equity as collateral for a down payment on a home. They'll value it at the time of the home appraisal. And it's, you basically use your equity, which you normally just have to sell before you actually even get a loan. And now you don't have to sell it until you actually close on the house. And I think it's an innovative product.
Yeah, I think it's interesting. I mean, I think it makes a ton of sense to try to give people the ability to access some liquidity on top of what's otherwise an illiquid asset, but does have value. I think there are certainly risks here. Couldn't tell from the piece whether, how this was structured and whether it would be possible for companies that, issue warrants or RSUs or other sorts of instruments as opposed to sort of pure stock. But, those are sort of details, and it's probably just my old lawyer brain starting to churn. I think it is an interesting offering, and I'm sure there are a bunch of companies out there that can take advantage of it. And I wouldn't be surprised to see others try to do something similar.
I think the home ownership question of people, whether they're small or small business owners themselves, and they don't take like a every 2-week paycheck, or people like this who are getting stock. Finding alternative ways to get them into homes when they actually have the ability to make payments on those homes and own a home, I think is only a good thing, because there's plenty of people that make plenty of money, but they don't report it in a typical way. And this goes for even gig workers and stuff. Like accounting for these various types of professional careers that is outside of the norm. I think would be get a lot more people in homes than is today. Because I've been through the mortgage process a couple of times, and if I didn't get paid every 2 weeks, it'd be such a headache.
Right. And it's interesting that they started off with Amazon. Obviously, Amazon's one of the biggest employers of them all. And it seems like they're going to be going one by one. I imagine, as to sort of to Jonah's point, these things have to be structured probably unique to each company. And they're starting with the big guys, but sign of things
thinking outside the box at least.
Yep, indeed. Okay, moving on now. We want to talk about LendingTree and Upgrade. LendingTree announced that they have a new Visa card. Not that much of a big deal, but this one is a little different. This is the Upgrades is powering this card, and Upgrade's credit card. If you've been paying attention, it's not a typical credit card because each month your balance is converted into an installment loan, which means your higher minimum monthlies are higher than a typical credit card, but it also means you avoid the debt cycle of just paying off your credit card over years or decades. And this is the first time Upgrade's gone and sort of white labeled their technology, and they've got LendingTree on the hook. LendingTree has 25 million customers. That's a decent number. So they're rolling this out, and I'm a big fan of what Upgrade's done. I think it is innovative, and I think this is something that I mean, their first foray in doing it as a white label. I think it's going to be interesting to see how that goes.
It kind of plays into the two previous stories we just talked about, which is, embedded finance.
Yep.
And then, unique ways to offer a traditional product, which is a traditional credit card, but the way in which they calculate and do monthly payments is different. And, going into embedded and offering their services as white label, which is, kind of giving some uniqueness to it as well. So, all three of the last stories are kind of playing into each other.
Yep.
Yeah, it'll be interesting to see if the sort of term loan in lieu of a line of credit sort of revolving facility takes off as something that consumers like, because there's sort of, transparency and clarity in the sense that I'm, know that I'm paying it down over time. I kind of hope it does. I think it's an interesting, innovative product. So we'll have to see. It's a little bit like some of those BNPL models, just a different way to do what folks were doing before. And
Yep.
if it's really transparent, maybe it'll catch on.
Yeah, I mean, I think it's the thing they've got against them. I remember talking to Renault about this when they launched. It says, are people going to want to have a much higher minimum monthly payment? That's the question. If you've been used to paying the minimum or paying not very much, you're probably not going to want the Upgrade card, but because it's going to force you to pay double, triple, quadruple, that's maybe what you were paying.
Yeah, but if you look at over time, if the one balance comes down by a if not significant, at least a decent amount, and you look at the other card and you're like, I can't get ahead of myself.
Yep.
Then maybe you reassess that in a year or two.
Yep. I mean, and I think it's a better product than the credit card product. I'm convinced of it. It's just, I don't know if the public is, I mean, I don't know whether it's going to remain a niche product or whether it's going to have wide adoption. I hope it has wide adoption because it'd be much more healthy for the country if it did. But anyway, staying with credit cards or credit card companies, maybe credit card networks, shall we say. Visa and MasterCard were in the news this week. And there was an article in Reuters saying they are hitting pause on crypto. And, Visa, remember we saw the quote from Kai Sheffield that we talked about earlier this year, I think, on the show, saying Visa's a crypto company. And, Kai Sheffield is the head of crypto at Visa. And so, of course, he's going to say that. And Ron Shevlin made the point that I don't know if everybody is going to be on board with that statement at Visa. But seems like Visa might be a crypto company, but they're pausing things. I mean, obviously they had a partnership with FTX, which obviously went by the wayside in November, and it was only recently announced that was not a good thing. But there's plenty of crypto credit cards out there, crypto rewards cards. I mean, Upgrade has a crypto rewards card, and lots of just traditional credit cards where you get, instead of getting frequent flyer miles, you get rewards in cryptos. So crypto's kind of here to stay, as it seems like, in the credit card space, but Visa and MasterCard seem to be taking a cautious approach. What are your thoughts, Jonah?
Yeah, I mean the networks are going to respond to demand coming from their issuer, their acquirer members, right? And merchants who want to do something related to crypto, or issuers who are looking to satisfy demand from their end customers. And that demand was a lot higher a year ago than it is now. And to your point, Peter, there's a lot already out there in the market. So a pause just means we're not doing, we're not rolling out new products anytime soon, which probably makes sense in the current environment and probably reflects demand out there. But I will have to see if crypto markets pick back up, sort of whether demand resurfaces. I doubt very much that Visa, MasterCard, other payments networks are shelving the projects they've had around crypto and blockchain technology, because they've been very sensitive to thinking very far out in the future about how their networks could potentially be impacted by those technologies. I'd be shocked if that work's not ongoing.
Right.
Do you think any of this or part of this is due to the regulators just being very aggressive right now, and they just don't want to run I mean, in addition to what you've said, which obviously makes a lot of sense, but they're probably getting some signals from the regulators like, we're being quite aggressive right now, and let's not go too far out from where you guys currently are.
Yeah, I'm sure that the regulatory environment is impacting, in particular their issuer members, and thinking about what kinds of products they want to offer to their customers, and for the networks themselves, thinking about, what are the standards they're going to hold their issuers to in offering those products. So I'm sure that that's playing a bit of a role.
Right. Well, that segues nicely into our next topic, which I'm putting. This was an opinion piece in Forbes, and I wanted to put it in because it was sort of a counter argument to what we've been saying on the show for months now. And this is basically the article was, crypto companies must stop poking the regulators in the eye with a stick. Great headline, and basically saying that the SEC have made some calls, and they've said things like, some tokens are securities, but then Coinbase continues to trade them on their platform, and basically saying we should be collaborating. I know in the defense of the crypto companies, sometimes they're really trying to collaborate with the regulators, and the regulators are giving them the cold shoulder. But I wanted to mention this because I feel like we have been bashing the regulators on this show for months, and maybe we should be trying to be a little bit more. And you also talked about Custodia, suing the Federal Reserve. Maybe that wasn't the best approach, but that's what happened, and she got Custodia got rejected. But like Jonah, what are you talking? I know that you're deep in this space. I mean, are the crypto companies being too aggressive with the regulators?
Yeah, I think. Look, I'm not going to opine on Custodia or any other individual institution in terms of how they engage with the regulators, because I only know what I know. But I do think that the crypto sector generally has had a hard time figuring out how to engage with regulators, and I think they've basically taken a pretty hardline approach, thinking that they could holding out for something of a new framework, if you will. I mean, if I go back 5-6 years, I remember asking companies, "Hey, why don't we go in? Let's go ask the SEC for a no action letter to do what you want to do." And understanding that there are some frictions between the way you want to operate and the way the securities regulations are currently written. And they would say, "Well, I can't do that. That's going to take me like 2 years." And here we are 5-6 years later, and we don't have a lot of regulatory certainty. I think neither the regulators nor the industry itself has really been all that constructive in putting concrete ideas on the table, really identifying where the challenges and the frictions are, and trying to plot a path forward. So I've been a little bit frustrated with both, and I think I've aired that view on your show before. So I don't know. I think the frustrating thing for the industry now is, in light of everything that's happened over the last year, how do they even get a seat at the table here?
Right.
If we're going to actually be moving forward with something here. So it's going to be a little bit more challenging going forward to have that sort of constructive dialogue.
I think of the two, I think the crypto industry made the bigger flub, so to speak, because the regulators aren't going anywhere. The crypto company doesn't have to operate. Like if the way in which I think they came in, and there was two things I think they did wrong. One was, we're going to revolutionize everything in 5 years, which clearly didn't happen. And two was that the stance they took was that we don't need the regulators. We can build fast, we can build strong, and there's a community out here, like, my keys, my crypto, all this stuff that I think played into, let's take a certain stance against regulators. Not all the companies, there's plenty of companies that wanted to probably interact, but there was also this movement of decentralization and against the current established financial system, which I think played into some of these companies, like, all right, we're going to poke into, to take the term from the story, we're going to poke into the regulator because that's where the base of our users are. And I think it was a mistake. And I think also the speed at which they thought things would happen would be a mistake. They needed to take that slow build approach, kind of like Custodia did, and I think they were unfairly treated, but others didn't, and I think they're kind of dealing with that today.
Yeah. Anyway, we are out of time. I'll have to leave it there. Thank you, Jonah. Really appreciate you coming on.
Thanks,
the show
Jonah.
Today. Thank you, Todd, as always. And of course, thank you to the listeners and the viewers. Appreciate your attention. We'll be back same time next week, 5 p.m. Eastern time, streaming live on YouTube and LinkedIn and Twitter. And if you can also catch us after the fact, obviously, on either of those platforms. Before I go, though, quick plug, Fintech Nexus USA, happening in May 10th and 11th in New York City. It's going to be huge. Grab your ticket, fintechnexus.com. See you there. And thanks again, everybody. Bye.
See ya.